Welcome to Talk Tickers. Today, we're digging into Chewy's Q3 2025 earnings call, which dropped right before the market opened on December 10th. And let me tell you, this report really got the market talking.
Yeah, this one created a really volatile session. On one hand, you have these fantastic results, but on the other, a surprisingly conservative forecast for the all-important holiday quarter. It really created a tug of war for investors.
Okay, so here's how we're going to break it all down. We'll start with the headline numbers, then we'll unpack what's really driving the performance. After that, we'll dig into the guidance that kind of spooked investors, cover the key questions analysts were asking, and then we'll wrap it all up with our call on the stock.
All right, first up, the results themselves, and honestly, they were solid across the board. It really showed some serious momentum heading into the end of the year.
Chewy delivered a 7% surprise on the bottom line. That's a pretty big deal, and it shows they've got a real handle on profitability.
Now, this is where it gets really interesting. This marks the fourth straight quarter of accelerating customer growth. That's a trend you absolutely love to see. It's a very, very positive sign.
And it's not just that they're adding more customers, they're also getting each customer to spend more. That 1-2 punch is exactly what you want to see for sustainable growth.
And this chart just brilliantly illustrates their operating leverage. Gross margin expanded by 50 basis points, and adjusted EBITDA margin expanded a full 100 basis points year over year. They're just getting more efficient.
So let's move on and see how this all built, because the real story here is that recurring revenue engine. It's just picking up steam.
The auto ship subscription program, well, it's the structural pillar of the entire business. It grew over 13% and now makes up almost 84% of all sales. That is an incredible foundation.
And layered right on top of that is the Chewy Plus paid membership. It outperformed even after they hiked the price from $49 to $79. It's really accelerating this powerful flywheel.
But the company isn't stopping there. They're making an aggressive push into higher-margin health services with their vet care clinics and the recent acquisition of SmartEquine. This is a huge strategic shift.
So, with all this momentum, you've got to be asking, why did the stock's initial 7% pre-market pop completely fade? Well, the answer is all in the Q4 guidance.
Yeah, management's outlook for both the top and the bottom line, it came in just slightly below what the consensus was looking for. It signaled, potential holiday promotions or maybe some macro pressure.
But despite that soft near-term forecast, management's commentary on the call projected just a ton of confidence in their long-term margin and market share goals. It's a real contrast. And that contrast, right, that difference between the short-term caution and the long-term optimism, that's exactly what framed the key questions from analysts on the call.
The smart money was really focused on whether these positive trends are actually sustainable, and of course, how quickly the investments in new things like vet clinics are actually going to pay off.
So, the crucial question is, how do you position this stock right now? How do you balance that strong execution against this cautious guidance? Let's really break down the bull and the bear case here to arrive at a rating.
Okay, after weighing everything, we are initiating coverage with a market perform rating.
So here's our thinking. The bull case is strong, no doubt about it. The subscription model is proven, customers are coming back, and the health services move is a clear path to better margins. But that bear case, the muted Q4 guidance, it just raises some questions about what's coming. So, even though the business is executing incredibly well, we believe that cautious outlook has appropriately capped expectations for now, making it fairly valued.
And before the final thought, just a quick and important disclaimer. This is not financial advice.
Now, for those of you with the more aggressive thesis, you could consider a paratrade. You go long Chewy, betting on that integrated ecosystem, while shorting some of the traditional brick-and-mortar pet retailers who just don't have Chewy's powerful digital and healthcare platform.
And really, this is the ultimate question for investors. Is this Q3 performance an inflection point? Can Chewy prove it can become a true compounding platform, regardless of what the economy is doing? The answer to that is going to be the difference between a good investment and a great one.